In this video, guys, we're going to answer the question, if an index is made up of stocks, why do we get patterns on the charts of that index? Great question from a subscriber. Stick around. Hey traders, warm welcome to you. Thank you very much for joining me. And this is a really good question. I appreciate all your questions and comments. And this one was something I thought about quite a lot. And so I'm going to share with you my thoughts on this. But as always, I know I've got a really intelligent group of traders out there who are subscribers, really useful comments, sensible comments, most of the time, sensible comments. If you want to put your input in this one, this is the perfect video to hear what you guys have got to say, because I don't know whether I'm right in the way that I'm approaching this, but this is the kind of way that I look at it and the way that I think that it works. This is a great question. So the question is really this, is that if an index is, let's say S&P 500 is a group of 500 stocks, why does that actually have chart patterns on? Because really all it is the valuation of those stocks moving up and down, and they're all individually weighted, a little bit of formula applied, and there's a number comes out the other end, and that's the index. So, and obviously there's a cash, and then there's another formula applied for the futures contract. So why do we still get these patterns on charts? And it's a great question, one I've thought about a lot before. Now, which comes first? Is it the stock price is moving the futures price, or the futures price is moving the stock price? And this is my thought on it. So for most assets, let's use the S&P as an example, we've got a couple of venues where you can trade the asset directly, i.e. the S&P 500 is 500 stocks, we can trade 500 stocks individually, or we can trade the ETF, which is SPY, or we can trade the futures contract, ES. Now, people who are trading SPY and people who are trading ES, let's put SPY in there and ES in here, they are trading the aggregate valuation of the S&P 500. They don't really care about the underlying value of each individual stock. So there's enough supply, demand, movement, money flow movement for that asset alone. So in other words, when someone comes in and buys 1 million shares of SPY, they're buying it because they want to invest in the 500 stocks as a group, or the economy in the US, whatever, however you want to look at it, right? They're not bothered about the individual stocks. And of course, if someone does that and things go slightly out of line, let's say these two venues run in sync. So in other words, if someone comes in and just sweeps the order book on SPY, then it's going to come back into sync, because ultimately, the futures contract is going to lift up to match the SPY, or the S&P 500. People will buy 500 individual stocks and bring it up and, to match the SPY. So there's a triangulation arbitrage going on. It's not that much. Don't get so excited. Not for us retail guys, and probably nothing in there anymore for the average institutional guy. But it used to be before. You used to have like a FTSE 100, a monitor up, and very often you'd see someone sweep the order book on the futures contract, and all of a sudden it would just flash blue, where people would just be buying as many FTSE 100 shares as they could on that offer, and selling futures contracts to lock in the arb, and they'd do that all day long, and there'd be an opportunity. Whether that's there anymore, I don't know. But say, for example, someone did just come and sweep the order book, then in theory there's an arbitrage that would settle that. So these are always going to be in sync. But the point is, the question is, why do we get chart patterns? Well, I believe that we've still got, the supply demand coming in for the individual group, if you like, the individual index. So that's why we still get, whatever patterns we're looking for, because that on its own is almost a stock. If you see what I mean, even though it's made up of individual stocks, it's almost a stock. Now, question could be, well, what about sometimes when we have a stock that's heavily weighted that moves things unusually? Great question. And that is when things change. In fact, just recently we had Boeing really, really heavy weighted in the Dow. The Dow becomes very challenging to trade. And I just have a rule where if we have something that's very heavily weighted moving the market, I don't trade that market, because exactly that, the charts don't look that good. They always break the patterns. They're not unusual. You just get a different feel for it. It just feels odd. And that's because it's purely being driven by Boeing. So all the supply demand, the main supply demand's coming into Boeing, and the Dow is a passenger. Even though it's got its own supply and demand, also you can trade the Diamonds ETF, or you can trade a YM. It's got its own supply demand, but the big driver, people are caring more about Boeing, so that's influencing this. Whereas when you flip it, normally this doesn't have much of an influence. Each individual stock is so small in its effect of the underlying market that yes, it can be its own little pattern, and that can be its own little pattern, and that can be its own little pattern, but the aggregate still has its own little pattern as well, even though it is made up, if that makes sense. Because there's pure lots of volume. Don't forget, the highest traded ETF is SPY, so people are trading that. Okay, and then the question could be, what about something like DAX, where it's a little bit smaller? I think that still applies because there's a lot of futures contracts. However, this is where it gets interesting, and I think there's a little bit of a turning point here. If you have an ETF, for example, which you could assume is the same as an index, right? We'll make that assumption now because it's just a kind of valuation, aggregate valuation of a group of stocks. Let's say you've got a really obscure ETF. Let's say it's got 10 stocks in it from a specific sector, and it's called, whatever ETF it's called. It's called, I don't know, a Wellington boot ETF, some ridiculous exposure to some kind of new rubber boot. The worst example in the world, I don't know why I came up with that, but you bear with me. So for example, you've got that. No one really trades that ETF, but there's companies in there that manufacture these Wellington boots that people think they want exposure to because it's the latest thing. So the ETF doesn't get much volume in it, but everyone trades these companies. Now, that chart probably wouldn't have reliable patterns because it doesn't have its own supply and demand coming into it. No one's trading that Wellington boot ETF. Everybody's trading these individual Wellington boot companies. They're like trading the factory, they're trading the supplier, they're trading the retailer, they're trading the supply chain, they're trading the logistics company, all dealing with this new product that everyone's excited about for whatever reason. And that's then creating the value of the ETF. So you can't then trade the chart, so to speak, because it doesn't really have its own supply and demand. Nobody cares that this happens to be at 28k, which they do on the Dow. A lot of people just care about that, and that's why you get a lot of sellers coming in, and that's why things stop. And that force is generally enough to stop the kind of flow of if there's any buying coming in on those stocks as well, because ultimately people are selling futures contracts and selling ETFs, and so stocks won't go any higher, probably because don't want to be an arbitrage opportunity. So, but if that was the ETF what no one cared about, there's no actual volume flow in the ETF, it was all in those Wellington boot companies, then this 28k will be irrelevant. It will just go through, it'll tickle down, and no one would care because it's not being traded. So I think that's the kind of answer, if you like. And let me know your thoughts on this, guys, is that, when you have a product that's so well traded on its own, then that's why it has its own pattern, because people are watching the levels, people are watching prior highs of that asset. And so the stocks have to kind of toe the line unless one goes out of sync, and that becomes the most, really skewed one, of course, like Boeing. However, when we get to stuff that's smaller, like some sort of ETF on whatever it may be, whatever example we had, then it doesn't matter. And then you can't look at the chart as effectively, because ultimately, it's just then, aggregate of stuff that people are actually trading that directly. They're trading the companies directly. So there's a turning point at some point. I think most of the major indices are all in this group. I think when you get to ETFs, you're probably going to find some that are in their own little world, and it's very, very unlikely you're going to be able to do charting on them successfully purely. Listen, you can still use trends and still say this is just the trend of the aggregate of companies, of course, but you're trying to fine tune things, double tops, double bottoms for levels, probably isn't going to be as effective because no one's actually watching that underlying asset. It's purely an aggregate of those companies that are in the ETF. So let me know your thoughts on that, guys. I think it was a great question and something you think about quite a lot when you're trading these things. I think you kind of have to accept as a trader that is the real answer, is that there's supply demand purely on the market you're trading. It happens to be an aggregate of made up of a basket of stocks in the index, but still that itself has its own demand from people, money flowing in and money flowing out. Anyway, guys, take care, keep the risk manager, whatever you're trading. I'll see you in the next one. Goodbye.